Imagine waking up to the news. Beijing freezes all US assets. The world as you know it has changed overnight. The headlines are everywhere, and the sense of disbelief is palpable. People scramble for answers, but the reality is clear. A new kind of war has begun, not with bombs or missiles, but with money and power. In a single, unprecedented move, China has pressed the nuclear button of economic warfare. The decision is swift, calculated, and sends shockwaves through every corner of the globe. It's a message that no one can ignore. Every dollar held by American companies in Chinese banks is now inaccessible. Overnight, billions are locked away, untouchable, as if they never existed. The financial arteries connecting two superpowers are suddenly severed. Factories, equipment, and joint ventures are seized overnight. The shock is immediate. American executives in China are left powerless, watching as years of investment and hard work are confiscated in a matter of hours. The New York Stock Exchange halts trading as markets crash, erasing trillions in value. Panic spreads faster than any virus, as investors realize the scale of the disaster. The financial world is in freefall. This isn't just about numbers, these are the life savings of millions, pension funds and college accounts wiped out in hours. Families who thought they were secure now face an uncertain future, their dreams and plans evaporating before their eyes. The rules of global commerce are shattered. Decades of trust and cooperation are undone in a single day, leaving businesses and governments scrambling to adapt to a new hostile reality. The world enters a new era of conflict, fought with spreadsheets, not soldiers. Boardrooms become battlegrounds and economic strategies replace military tactics. The weapons are numbers, algorithms, and policies. Companies like Apple and General Motors see their investments vanish. Decades of expansion and partnership in China are erased, leaving empty offices and abandoned factories as stark reminders of what's been lost. Starbucks stores across China are paralyzed. The familiar green logo, once a symbol of global connection, now stands for uncertainty and loss. Stock prices collapse, sending shockwaves through every investor and pension plan. The ripple effects reach far beyond Wall Street, touching every corner of the world economy. This is more than a financial move, it's a declaration that trust between the world's two largest economies is gone. Diplomacy falters and alliances are tested as leaders search for a way forward. The assumption that US and China were too intertwined to sever ties is destroyed. The world must now confront a reality where old certainties no longer apply. The move is a financial Pearl Harbor, a surprise attack that changes the world forever. The shockwaves will be felt for generations, as nations and people struggle to rebuild what was lost. The global order, built on the free flow of capital and goods, is left in ruins. Trade routes are disrupted, supply chains broken, and the very foundation of globalization is shaken. The path forward is uncertain, and the world stands on the edge of economic chaos. Every nation, business, and family must now navigate a landscape transformed by fear and instability. The era of economic stability is over. A new chapter begins, one defined by risk, uncertainty, and the urgent search for a new balance in a world forever changed. The shockwave from Beijing's decision instantly becomes a global contagion. Stock markets in London, Tokyo, and Europe crash. Investors scramble for safety, gold, Swiss francs, even cryptocurrencies. The US dollar, once the world's safe haven, faces a crisis of confidence. International banks with exposure to US or Chinese markets teeter on collapse, threatening a financial crisis bigger than 2008. Central banks worldwide inject emergency liquidity to prevent total meltdown. Multinational corporations face disaster as supply chains snap overnight. The intricate dance of global logistics halts, leaving business leaders scrambling for alternatives. Commodity markets swing wildly. Oil prices crash while rare earth minerals skyrocket. The world economy is caught in a violent storm, with prices for some goods crashing and others soaring. To truly grasp the scale of the catastrophe that could unfold, we must first understand just how deeply the US and Chinese economies are woven together, far beyond simple trade. For more than 40 years, American companies have poured billions of dollars into Chinese factories, seeking not only new markets, but also the efficiencies of low-cost labor and vast manufacturing capacity. Meanwhile, China's massive trade surplus with the US has allowed it to accumulate huge reserves of US dollars, which it then invests in US Treasury bonds. This creates a unique financial symbiosis. Each side depends on the other to keep their economies humming. America borrows to buy Chinese goods, and China, in turn, lends back the profits, fueling a cycle that has become the backbone of global finance. Chinese companies have also flocked to U.S. stock exchanges, raising billions from American investors eager to tap into China's explosive growth. At the same time, U.S. financial firms manage wealth, advise on deals, and invest in China, further deepening the web of financial interdependence. The financial health of one country is now so closely tied to the other that a shock in New York or Shanghai can transmit instantly across the Pacific, shaking markets worldwide. Freezing U.S. assets in China would tear apart this intricate fabric, abruptly halting the flow of capital and trust that powers not just these two nations, but the entire global economy. The U.S. relies on China for affordable goods and efficient manufacturing, while China depends on American consumers and access to U.S. markets to sustain its growth. This relationship, often called chimerica, has defined the global economy for an entire generation, shaping everything from jobs to interest rates. If it were to end suddenly, both nations would face not just economic pain, but a void that would ripple through supply chains, jobs, and communities worldwide. The consequences would be swift, severe, and nearly impossible to contain, with financial markets in turmoil and businesses scrambling to adapt. The world's economic engine would grind to a halt as trade, investment, and confidence all freeze. The fallout would be global and generational, reshaping lives, livelihoods, and the very structure of the world economy for years to come. The initial shock is just the beginning. What starts as a single event quickly spirals outward, sending tremors through every corner of the global economy. The U.S. would retaliate, freezing Chinese assets, treasury bonds, real estate, and more. This unprecedented move would send shockwaves through financial markets, undermining trust and stability. Economic ties would be severed, plunging both nations into a full-blown economic war. Tariffs would skyrocket, trade would grind to a halt, and businesses on both sides would scramble to adapt. The world would be forced to choose sides, splitting into rival economic blocs. Old alliances would be tested, and new partnerships would form out of necessity, not trust. Countries like Germany, Japan, and South Korea, dependent on both U.S. tech and Chinese manufacturing, would face impossible choices. Their industries would be caught in the crossfire, risking supply chain collapse and economic stagnation. Resource exporters like Australia and Brazil would see their economies thrown into turmoil. Demand for their goods would plummet, and their trading partners would become unpredictable overnight. The principle of safe international investment would be destroyed, making companies wary of investing abroad. Cross-border deals would dry up, and global finance would enter a period of deep uncertainty. Capital would retreat, supply chains would be reshored or friendshored, and costs would soar. Businesses would struggle to adapt to new realities, passing higher prices on to consumers everywhere. The result, a deep, prolonged global recession, with unemployment and uncertainty everywhere. Entire industries could vanish, and millions would find themselves out of work. Governments would scramble to manage the crisis, their resources stretched thin. Emergency measures would be enacted, but recovery would be slow and painful. The interconnectedness that once drove prosperity would now spread economic pain worldwide, reminding us just how fragile our global system truly is. Beyond the headlines, the real story unfolds in everyday lives. Shortages hit stores as Chinese-made goods vanish. Prices for essentials skyrocket, fueling inflation. Layoffs ripple through companies with frozen assets. Tens of thousands lose jobs overnight. The pain spreads. Factories halt, truckers and retail workers are hit, unemployment soars. Retirement savings evaporate as markets crash, forcing older workers to delay retirement. Home values plummet, erasing middle-class wealth. The sense of financial security is shattered, replaced by fear and anxiety. Social unrest and political extremism rise as people search for answers. The fabric of society strains under the weight of economic collapse. Behind every statistic are real people facing hardship and uncertainty. China's asset freeze would be an act of mutual destruction. U.S. retaliation would freeze China's investments, including treasury bonds, wiping out reserves. China's reputation as a safe place for investment would be destroyed, foreign capital would flee. Factories dependent on U.S. markets would close, triggering mass unemployment and social unrest. China's ambitions for technological leadership and global influence would be set back by decades. The Belt and Road Initiative would falter as partners lose trust. The yuan's credibility as a global currency would be shattered. In trying to cripple its rival, China would isolate and damage itself. The asset freeze is the extreme endpoint of a process already underway, U.S.-China decoupling. Both nations are reducing mutual dependence driven by security concerns. The US uses tariffs and export controls to block China from critical technologies. China pursues self-sufficiency, investing in domestic industries and reducing reliance on the West. The dream of a single global economy is fading, replaced by competing economic blocs. The asset freeze would be a violent severing, not a gradual separation. The world is moving from hyperglobalization to strategic competition. The question is not if decoupling will happen, but how far and how fast. The US-China financial schism forces us to ask, is globalization over? For decades, integration brought efficiency and prosperity, but also fragility and dislocation. The rise of China as a rival and the vulnerabilities exposed by crises have shattered old assumptions. A crisis like an asset freeze would accelerate the shift to fragmented globalization. Trade and investment would realign along geopolitical lines, friendshoring among trusted partners. The global economy would be more resilient but also more expensive and less efficient. Geopolitical risk is now front and center in every business decision. The new reality demands resilience and security alongside growth. Ultimately, this is a story about people. The factory worker whose job vanishes, the small business owner whose savings are wiped out, the family struggling with inflation. These are the faces of economic conflict. The interconnectedness that once seemed a strength is now a vulnerability. Navigating this new world requires resilience, adaptability, and stronger communities. Policymakers must manage the transition thoughtfully, avoiding chaos and isolationism. Diversifying supply chains, investing in domestic industries, and building alliances are key. The risks are real, but so are the opportunities to innovate and build a fairer economy. The future will be shaped by the choices we make today. Our response will define the next era, not with fear, but with courage and foresight.